everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. As you can tell, more familiar backdrop, so I'm back in the dragon capsules, I like to call it, with the office with multiple screens, etc. A lot easier way to access and check out the markets, do research, stuff like that. But I was going to say it's nice to be back in sunny, warm Florida. It's sunny, but for Florida, not quite so warm. High of 60 is not necessarily what we're used to, with a little cool breeze, but sure beats being in a basement in the Appalachians. It's nice to see the snow and all those things. So I'm kind of one of those that I enjoy the snow as long as I get to leave, but I don't have to stay and live in it. So anyway, with that said, let's go ahead and move forward. For those of you that may be new with us, for this TradeFinder, we go through this disclosure each and every week. It's very important. If you haven't seen one of our videos before, please take a screenshot of it, look at it in detail in your leisure. The important things that the powers that be want us to make you aware of is, number one, we are not registered to give individual investment advice in the United States. And secondly, because we have a lot of international viewers, we have a lot of international subscribers, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. So those are the big things they want you to know. But again, take a look at it when you have an opportunity and read through it, because it is important. For those of you that are new, the way this works is we'll take a few minutes to go through the market. And from there, I'll go through and show any case study alerts that we may have closed for our subscribers on our website. It gives you an idea of how the process works with the alerts and what we're doing. After that, then we'll go through and update you on alerts that we have looked at, or I should say case study considerations that we've identified in previous trade finders, see how they're doing. And once we've gone through that, we'll look for some potential case study considerations tonight. We'll select one, and then from that point forward, I'll take questions until we run out of time. So that, let's get moving forward. So here's a look at the market. Hopefully you can see the screen that the wave 5 is up 93% at this point in time. So we are getting there. I feel like we've been talking about this zigzag pattern forever, but because we do add new people each and every week, let's go ahead and go through this. And you can see that that target price, we've mentioned it in S&P video updates. We've mentioned it in these TradeFinder classes. We talk about it with our insiders. What that is our subscribers. We do a live event every week where they have the opportunity to send me questions anytime they want through email. We have a great support staff. We actually have a 24/7 support staff for general questions. But if there's a question specifically for me, our subscribers have the opportunity to access me. But then each week we do a live interactive webinar where we cover each and every one of our alerts. So we update our subscribers every week on our alerts. And then if there's something that needs to be covered in between, I post commentary on our website. We like communication. We're really big on communication. Now notice this move to the upside in the S&P. There's good things and there's bad things. The good thing, or one of the good things, is if you've listened to anything that I've recorded, you know I like a 45-degree angle move. And look how that move in the S&P is just following along right with that C wave forecast extension up to the 381 level. It's just moving nicely through that path. And we're not that far away. We're getting awfully close to that 381 level. So the whole melt up thing we've been talking about, at least thus far, and of course we know everything can change in a day. That's how markets work. But at least up till this point, we're moving up to that level exactly as expected in the whole melt up scenario. Now the negative, I want to take this off, the zigzag pattern off, and with the 93% extension, 100% is going to be right at that 381. So you've got a wave 5, 100% extension, and a C wave in the zigzag at the same exact spot. So when you have more than one Elliott Wave pattern target at the same price, common sense would tell you that has a higher probability of occurring. There's been a lot of people on the S&P YouTube videos saying there's no way we're going that high. Other people have thought, yeah, we are going to have the melt up. That's what makes markets, differences of opinions. But when you look at this, you can see this is the whole melt up thing here. See, there's low intraday volatility. The bars are small. That's what happens this time of year quite often. And that's what we've been talking about. Now, you go back and look at, wow, this is looking a little ominous, really, with getting into the point of, is it a triangle or is it a diagonal? We tend to think that we're in an Elliott Wave diagonal, and diagonal patterns end with a corrective move the opposite way of where the diagonal was moving. We just, not too long ago, posted a whole educational series on diagonals on our website. You can access that if you would like via our website, ewotrader.com. But looking at this, it seems to be setting that up. If nothing else, it's a pennant pattern, which diagonals are really pennant patterns, if you will, but it's a well-formed Elliott Wave diagonal. And those, again, as I said, usually end with a reversal in the opposite direction. So we're getting to the point where we're starting to look at what happens when we hit that 381 level. And it just seems that a correction is due based on this low volatility. Well, we like to look at the DMI. If you are bullish for the market to continue to the upside, here's something for you to hang your hat on. The ADX is moving up. It's broken above 20, which is my level. That's the level that I watch. If you read information about the DMI on the internet or wherever you get educational information on technical indicators, the level they would tell you is watch for 25. I think that's too conservative with our technical system, and that's what we have, is we have a combination of indicators that we look at in addition to Elliott Wave. So our indicators are the confirming indicators for Elliott Wave, the backstop, if you will. And with all of that information that we have, that we plug in the data, the AI data that we have, I just don't think that it's necessary to wait for 25. So 20 is the level that I like to watch. So we've already broken above that. We've broken above the negative directional indicator, and notice how the sellers are getting weaker. Now the buyers aren't getting super strong, are they? It's not like this is a big old long huge buying spree. It's more of a seller strike. Pardon me. Quite often we hear the terminology buyer strike. And this is kind of more of a seller strike where the sellers have just walked away. It's just the buyers. Yeah, we're inching up. You can see that we've had a pattern there of higher lows. So technical analysis is everywhere, even within technical indicators, which is interesting. But you're not seeing the huge move to the upside out of the positive directional indicator. Nevertheless, we do have decent separation between the two directional indicators. We have the ADX breaking up. We have it breaking above 20. It's between the two and about to break above 25. That's support for the continued move to 381. Then we get to what happens then, as I mentioned earlier. Do we go to the next level? I think the DMI is something that we'll look at very closely to see, is there enough support, technical support for the move to continue? Maybe at this point in time, I think it's a little suspect. I think if we go back and look at the history, you can see kind of how we were getting these low intraday volatility bars, and then boom, we were due for a pullback. So we're not talking about necessarily thinking that the whole world's going to come to an end here, that we're going to come crashing down. Anything's possible. We could be due for another correction, but we had a pretty big correction in March. But some sort of a correction seems to be in the cards. And I just wanted to remind you of this. So I'm going to go back one more time and put this zigzag pattern on here, is that when you go to an extended level, quite often the market will come back, retest the previous level before moving to that extended level. So if we take a look at where we are here, let's go ahead and add on the 161.8% level, which would be the next target. That's 422. We've heard that there have been some market pundits, if you will, talking about a potential move to 420. It's possible. You can see where they're getting the number from. It's the fib extension level. We talked about this a while back. We haven't talked about it too much recently, but now that we're so close to 381, I think it bears repeating and going over again. I think we're going to have to rely on our confirming indicators to see, is there enough momentum to move past that 100% up to 161.8. At this point in time, I think it's suspect, but it's a possibility. And we'll revisit that once we do hit that level. But I just wanted to remind you that that 420 level was up there, and you've probably heard, if you've listened to the financial networks, people talking about it. All right, so that's where we are with the market. We did close a number of alerts. I just wanted to highlight a couple for you. One of them is DataDog. And the reason that I wanted to share this one with you is because this is an example of what we do a lot at Elliott Wave Options and what I'm a big believer in, which is the adjustment process. I think that making proper adjustments is the key, maybe the primary key that determines whether you're a successful trader or a non-successful trader, because we all know you're going to be right and you're going to be wrong. Nobody is right all the time. How do you handle being wrong? You know, being right, we can argue a number of different ways to handle that, but that's an easy issue. It's a lot easier than how you handle being wrong. So we set up with DataDog. Our entry here was on October 14th. Here was the pattern that we were looking at. You can see we came out of this flat. The B wave had a 75% corrective move, so we knew that was a flat, and we had an impulse move to the upside. Well, when you have an impulse move, the problem is, how far does that A wave go? So when you have the initial impulse, it's just like the wave 3 within the 5-wave pattern. The reason people shy away from that, knowing that everybody agrees that the wave 3 is the strongest of all waves, quite often the longest, not always, quite often the longest, but always the strongest of the waves. But people still shy away from trading it, which I think is a mistake. But their reasoning is they don't know when the wave 3 is going to end and when the corrective move is going to occur. Well, that's the same thing that happens in a 3-wave zigzag. You don't know where the A wave is going to end and the B corrective move is going to come in. Well, you look here and we had a pretty good confirming DMI here. You could look at that and say, well, yeah, it's positive directional indicators, kind of like how it is with the market right now, right? It's not flying up as it might have moved with the upside. And in the end, we did get a corrective move back down. So what we did on the corrective move was we rolled the delta back to where you would say you rolled your data up because, or the delta up because the delta had dropped so much in the call option. So we rolled the delta up with a number of different reasonings. We were way oversold to the downside. We were sitting at a support level and we were going to hold here, or DataDog was basically going down to fill this gap down here below 60. So that was the last bastion of support. We were oversold with a 10-day moving average with that gap to be filled. It made sense from a risk to reward standpoint. This is the point where you want to make your adjustment, which we did. And so we added 2 more calls with a better delta. So we still maintain the original call, but we added 2 more so that now we've propped our delta back up to take advantage of a move back to the upside, which is exactly what happened. So the stock moved back to the upside here. There was that level that it tested in early November, and we pretty much went straight up from there. And then we got up to the point, well, now we're at resistance. We're back at 100. On top of that, we have accomplished our goal. Goal number 1 in an adjustment is recover the initial loss. So what I'm trying to go through here is, again, reiterating that everyone has winners and losers. And how you handle your losers, do you just take the loss and move on? A lot of people preach that. Well, it's been my experience that if you have some sort of a system where you hit X percentage loss and you do that every time, it's a slow bleed until your account's gone. Why not stay with the pattern? And if the pattern has gone against you, why did it go against you? What's the new pattern? The beauty of Elliott Wave is that if the original pattern becomes a failed pattern, in this case, it wasn't a failed pattern, it's just the corrective move happened. Then what's supposed to happen from there, the Elliott Wave pattern from there has a higher likelihood of occurring than the original pattern did. So basically what it's saying is that the percentages are now in your favor of the move following a move against you of following the rules and doing what it's supposed to do. Why walk away from that? That makes no sense to me whatsoever, even though a lot of people teach that. We don't do it that way. We try to manage the losses if there's a stock that goes against us. We have plenty of them that just go right the direction that we want them to. Those are great. We take those gains. I'm going to show you one right after this. Those are fun. It isn't always like that. That's not how trading works. You're going to have charts that move against you. You're going to have losses. To me, again, to reiterate it, how you handle being wrong determines what your level of success is going to be down the road. So in this case, we move back up. As you can see, we hit that level. We sold the contracts and we ended up with $870 there, closing everything out. And two things that occurred here. One, we recovered the entire initial loss, all of it, and ended with a 12% gain. So those that were in this position from the very beginning still made a 12% gain coming back from, there's the mark-to-market graph. Again, we talk about how transparent we are. You can see we were almost at 100% loss. We were at a 95% loss at one point in time. All of that was recovered and ended with a 12% gain. Now, we add subscribers all the time, and every time I do an adjustment, I will make a note in the alert that goes out for new subscribers. Hey, would this alert be okay for you to follow if you weren't in the original alert? And so in this case, yes, it was one of those that new subscribers could follow. So those that came in since the initial alert was sent out and only took advantage of the adjustment, you can see what they made, well over 100%. So $320, closing it out for $870. Pretty nice trade for those that were only in the adjustment. Really nice trade. So that was one of the ones that I wanted to share with you that we closed out. Again, we closed out several of them, like 5. I'm only going to cover a couple with you just in an effort to save time. And the other one that I wanted to show you, also in our impulse strategy here, was on TOT, Total. So it's an oil stock. We've talked about how energy and the financials have been doing well, so we wanted to participate in that. Well, look at this one. This is how we like all of our alerts to go. It's fun when they do this. They don't all do it, but when we get one, it's nice. So here was the entry on December 1st for Total. That's how they pronounce it. And you can see that we came back down to test support, but we're in a wave 3, moving to the upside. The target price is up around 50. So that's the eventual target price. However, the stock immediately just moved our direction. And we had this gap up, which got us, all right, everybody that's been here before, say it with me, no security in any time frame gets very far away from its 10-day moving average. You know, that is a rule. That is not a guideline. That is a rule. That's a hard, fast rule. It's always that way. That's one of those things that is about as concrete of a rule as you can come up with. So here we are. We had to bounce back up, and then we had a big, huge gap up. So we got a couple things. We got a gap here to fill, and on top of that, you can see it's an ADR. So ADRs, American Depository Receipts. If you see that on charts, that means that's a foreign company stock. The ADR is how it trades on the U.S. exchange. So what happens overnight has a lot to do with it. They tend to have gaps. They tend to have more gaps than stocks that only trade on U.S. exchanges. So you have to take that into account. It's not quite the same rule that I talk about as far as gaps getting filled and the data of 92 to 94% of the time gaps get filled. Slightly different when you're dealing with ADRs, but still, in this case, the gap up wasn't necessarily the primary concern. It was the fact that the gap up created an overbought situation. We're above the 10-day moving average. On top of that, we got a 60% return in 2 days. So 2 trading days, you take that. It's been my experience that when you get a move like that, don't get greedy. This is one of those times where don't get greedy comes in. Now, did the stock hit 50? No, it didn't hit 50. Will it? Maybe, probably. But when you have a gap up like this, you also have an IV rush that goes into the call options, especially the way we do them, where we look for that delta that gives you the massive or the maximum acceleration of delta and gamma, a little further out of the money. So they're definitely susceptible to the IV rush scenario. So that also goes into the thought process when you're thinking about closing out a position. So you don't want to lose that. And in addition to that, which I didn't add on this chart, you can see we're also at resistance. We were at the previous high from the end of November. So with that said, it was all those things went into, you take a 60% gain in 2 days, you're happy and you move on. And that's where I was saying that it's nice when that occurs. We wish all of our alerts went that way. They don't, that's not how trading works. So think of a system, which is what we do in Elliott Wave options, where you manage your losers. And if you can take a loser and turn it into a winner, even if it's only a small winner, and then you enjoy your winners that do what they're supposed to do you see how that can generate success over time? And that's what we've enjoyed. And this is why. This is our system. This is how we do things. So manage the losers, manage them back to a smaller loss, break even, or a small gain. Sometimes you get a still decent gain out of them. So manage the losers, take your winners when they come. It creates a pretty compelling story as far as where you end with your portfolio balance. All right, so sorry, I'm creating all kinds of issues here on the screen. So that's the alerts to update you on. Last week, we picked T-Mobile. So let's take a look at where that one is. If you've been following us, our record for our case study considerations with TradeFinder, we've been doing this for months and months. We only had one loser in all that time. And we had one for a while, and that one turned around into a winner. It's been phenomenal. If you just tuned in to TradeFinder and follow along with the case study considerations that we do each week, you're doing well too. So imagine what you could do if you were a full-fledged subscriber. We'd love to have you, especially now. Boy, I think we have a really fun January coming. I really do. I think January is going to be more volatile, and I think there's going to be some good money to be made in January. If you were ever considering being a subscriber, now's the time to go ahead and pull the trigger. Give yourself a Christmas present for a profitable 2021, because we can get it off to a good start with what I think is going to happen in January. So here's T-Mobile. So let's go back to last week. So 12/1. We closed at 133, and we are closed at 133. So we haven't really gone anywhere with T-Mobile yet. We're exactly where we were before. You can see that the ADX is still kind of, it's not the 45-degree angle I'd like to see the ADX moving, but it does have a slight pattern of higher lows within it. It's still between the two directional indicators. And of course, you would like to see that positive directional indicator making more of a move to the upside. If we're going to continue with this move higher, you can see that we're hugging that 10-day moving average. We got a little bit above it last week, but this was the best looking chart at the time. And so we'll see how that continues to play out from here. There's nothing in this chart that would change to the point of, this doesn't look as good as it did originally. It still looks good to continue to move to the upside. And so there's no reason to make an adjustment or consider an exit. Sometimes the best move is to exit a losing trade. Sometimes it is. But a high percentage of the time, you can manage a losing trade by following along with whatever the pattern's doing. And I think that's one of the reasons that we had such success with adjustments in Elliott Wave options, is because Elliott Wave itself is so quick to change with the market. If the stock's pattern changes, the Elliott Wave count changes faster than any other indicator that I know of. I love the DMI as a confirming indicator, but it lags. It's not quick to, the two directional indicators are more responsive, they're faster, but the ADX is slow. It's like turning a big ship in the ocean. So having an indicator like Elliott Wave that is quick to respond to the market is very helpful. So that still looks pretty good. Let's look at the other ones, just for the heck of it, that we didn't select. CME, see what they've done. So here's CME since last week. So go back to, this one's actually moved higher. So we closed at 179 and 183. So CME is up $4 from when we looked at it. So that one moved to the upside. And then Nike was another one that we had taken a look at as a potential. And that one's made a nice move. So you can look back at it and say, well, you had three of them and you looked at it. One of them's break even. That's the one we selected as our case study consideration. The other two are killing it. So there we closed at 135 and we're at 139. So we're at $4. So out of the three that we looked at, two are profitable, made money, probably decent money out of Nike. And then T-Mobile is break even at this point in time, exactly where it was when we got in. Sometimes stocks move at different time frames, but out of the three, you've got one break even and two winners. That's not bad from what we looked at. And then 2 weeks ago, we looked at TJ Maxx. So let's take a look at that one, TJX, see what that's done. That goes back to 1124. Here's our Elliott Wave pattern. So let's go back to 1124. We closed at 64.33. And then moving forward, there's 64, 65, 66, 66, 63. And now we're back to 65.42. So that one's profitable as well. So TJ Maxx from 2 weeks ago is profitable. Of the three that we looked at that were under consideration last week, two have been winners, one break even. So there you go. There's a good evidence if you're fairly new to TradeFinder of the type of record that we've had with these case study considerations. It's gone really well. All right, so let's go ahead and, there was one other thing that I wanted to share with you real quick. I'm actually going to do another S&P update this evening. I'm going to bring the market back up over here and show you this, what we sent to our subscribers today. So I think this is fascinating. Here is the newest alert that we sent out. You can see it just went out today. This is on ARKW. Now, everybody's familiar with the whole Bitcoin phenomenon, right? The Bitcoin craze, really expensive to trade in that market right now and really risky to trade in that market because it moves so phenomenally. I mean, people are like, oh yeah, well, they've made so much money. Well, the corrections can be pretty volatile as well. ARKW owns a trust that owns Bitcoin. So there's a trust, it's called the Grayscale Bitcoin Trust that actually owns Bitcoin in it. It's not optionable. ARKW owns the trust. So you have a roundabout way of owning Bitcoin, if you will, which is optionable. So now you can have the risk management, the leverage, and the risk management of options and trade in the Bitcoin world. Are you buying Bitcoin direct? No. Please understand you're not buying Bitcoin, but are you in a kind of roundabout way playing the Bitcoin phenomena? Yes, you are. So this is a security that I wanted to point out to everybody. And you can see that just from the time that we sent the alert out with our confirmed fill price, we're already up 15% because they kept running into the close of the day. So pretty good start for this, basically within a little over an hour from the time that we sent the alert out till the time the market closed. So I wanted to share that with you. And let's bring up the chart here. If you've been looking for something along these lines, here's one to at least consider. Now, you look at that, and that's not quite that 45-degree angle that I like, is it? It's a little more vertical, and I don't like that when they start to go vertical. You look at the 10-day moving average, we're a little bit overbought. So you could look at that easily and say, well, why don't you just wait a couple days and see if it comes back towards the 10-day moving average, and you could have gotten in at a better price. Well, a couple things here. Number one, we only put $370 at risk in this. We left room if there is a pullback to add to it because our normal target is $500 of risk per alert. That's what our normal set goal is to put right around $500 at risk per alert. And that's it for every alert that's sent out. So there's only 370 here, so there was room. We could have done another contract on this and gotten it there. The reason we didn't was because of this here. The toes are in the water now, and you look at this DMI, now that's what you want your DMI to look like. The ADX is moving up, great separation. The negative directional indicator is moving down. The positive directional indicator is moving up. Now the ADX is breaking above 30. And once it gets above 40, now you get to the point where the strongest part of that move is over. Doesn't mean the move is over. I reiterate this every time I talk about it, but doesn't mean the entire move is over. It means the strongest part of the move is over. The stock could still drift higher, but the big move is usually done. So do you sit back and wait for that to potentially come back to the 10-day moving average? It's not grossly overbought. It's just slightly. You could have a couple more big days that you missed to the upside if you waited. So the more prudent thing to do in a scenario like this is at least you're involved. And if we do get a big move, you make something. You make some sort of a profit. If it pulls back, then we can add to it because we have room to maintain our risk disciplines and add to the position if it does pull back. But anyway, I wanted to go through that with you and share those things. So let's take a look at our pre-computed scans. Again, for those of you that may be new, this program is called ProfitSource. A lot of people ask about it and like the way the charts look. So many different things you can do about it. And then over here, or do with it. And then over here, there's the searches. The ones that say EWO are searches that I use to identify the alerts that we send out to our subscribers. And they're included. If you're an Elliott Wave option subscriber and access this program, you get the searches too, which is a great learning tool. People ask all the time about stocks that are on the searches. Why did you pick this one? Why didn't you pick that one? It's a great learning tool. And in addition to that, they've just added some things because my searches don't have Elliott Wave in them on the actual initial search. It's the conglomeration of confirming indicators. And once we get those results, then apply Elliott Wave to those results. So I already know the confirmation is there. What's the Elliott Wave pattern look like? Well, now you can combine the two. So you can see that there's 88 consolidating stocks. That's moving up. Remember, it was 78, then 83, and now 88. So with the lower volatility in the market, you would expect the number of consolidating stocks to start to shrink. And last week we talked about, last week might have been the last one that we do from a directional standpoint. Let's take a look and see. We're not quite to 381 yet, but looking for potential consolidating stocks is something that would be smart to do. And we're down to 5 impulse stocks. So we can click that and then click the bullish wave 3 as well. And you can see there's 3, Nike's still there. So let's take a look at that. Nike was there last week. CFG is another one that we have sent out as an alert to our subscribers. We have OZK, Ozark, which is doing well. That one's about at its target to go ahead and take that one off as a profit. Maybe we'll be talking about that next week. It's one of the ones we've closed. And CFG is another one that's doing well. So you can see here that we have 2 financials and Nike. So looking at First Financial bank shares, let's take the rest of this off. And ADX moving up pretty nicely. Positive directional indicator with this move, you can see that we've had pretty good move to the upside there. I'd like to see that positive directional indicator moving a little bit more with that move, but let's see what the options look like. There is very little open interest and incredibly wide. You can't trade that one. Forget that one. Not a good trade for options. So here we are back to Nike. We looked at it last week. Maybe we should add that one in as a full-on case study consideration this week. You can see the ADX has continued to move up, and there's what you want to see out of your positive directional indicator. See how it went kind of back and forth sideways a little bit. Now it's moving to the upside, negative directional indicator moving down. So that's how you want things to look. And I do like this angle that the stock's moving up. That's that 45-degree angle that I like. And if you're newer and you're, what's the difference between that? When stocks move in that 45-degree angle, all stocks correct, right? Nothing moves in a straight line. Stocks move. If they're moving to the upside, if it's an uptrend, they move up, they correct, they move up, they correct. And in the end, you have an uptrend. But when the stock moves in a 45-degree angle, the corrections are not as volatile. So you get corrections, but they're more mild. So that's why I like to see the stock move in those 45-degree angles. So looking at that, that looks pretty good to continue. Let's see if this is, see that bar there? People always want to know, well, how do you know where an impulse move starts? Well, look how sideways it went, and then you have a big up day. That's the start of your impulse. Didn't quite make it to a 38% correction. So it's at 61.8 is where it should go. And that's where it is. Will there be an extended C wave up to 100%? Well, based on that DMI, you'd have to give it a pretty good chance of running up and getting to that 152 level. So we're at 139, move to 152. That could be a nice trade. So that looks really good. And then we'll go ahead and look at CFG as well. And you can see this one also in the financial world. Oscillator is momentum. And looking at the DMI, the ADX is moving up nicely. Positive directional indicator starting to move up. Negative directional indicator moving down. So sellers weakening, buyers strengthening. Nice wave 3 move to the upside here. The ADX is broken above 25, so it's above both 20 and 25. That one looks good to continue up towards this target around 39 or 40 in that area where the wave 5 target is. So that looks really good as well. So we've already sent that out as an alert to our subscribers, keeping in the theme of when you're in a market where it's pretty thin, you're in thin air, if you will, using rocket terminology. You want to stay with the sectors that have the money. So that's energy and financials. That's where the action is within the whole Bitcoin thing is a whole phenomenon on its own. But the sectors that are strongest are energy and financials. So if you're going to send out a directional trade, probably a smart thing to do to stay in those sectors. So both of those look really good. And we can, I mean, we already have CFG for our subscribers. So maybe let's look at Nike here with the expectation of going up. And we could have picked it last week. It's already moved. So let's put that in. And we're also going to run a search for consolidating stocks as well. Because I talked about it last week that we would likely start to move away from directional stuff. So here's the consolidating stocks. You can see there's 88 of them. Well, that would take a while to go through 88 charts. What we're looking for in the consolidating stocks is triangle formations. So let's go through and see if we're looking for triangle formations, see if there's any that have a consolidation, potentially a triangle, that are also within a wave 3. And you can see that there's, what, 5 that are consolidating in the wave 3. We don't yet know if they're triangle patterns. So that's where we have to take a look at this and determine, is there a triangle there, or is this a flat, a sideways consolidation? 2 S&P 500 type of issues, and we already know what's going on there. It's kind of a diagonal being formed, so I don't think we need to look at those. Ceridian, I don't really know what that is. And then you can see the ADX had dipped down. It's not really a triangle though. It just went sideways enough to allow the ADX to drop down. So I think we could probably do better than that. Let's try Truist. There you go. There's your triangle. Can you see it before I illustrate it for you? Look at that ADX dropping down, just dove down through this consolidation. And there's the triangle. Pretty easy to see, I think. This is what we were looking for. Now, Elliott would say, this is probably breaking to the upside. Oh, wow, check this out. This is a pretty interesting pattern. Had an expanding triangle that broke out and then went right into consolidating triangle. 2 triangles back to back. We've seen that before, but it's not very common. It doesn't happen a lot. So this is the merger of BB&T Bank and I think SunTrust were the 2 that got together, and now they're Truist. So it's not, if you haven't heard the name, it's not like they haven't been around. It's super liquid. Thousands of contracts in the options. Not a problem. Tight spreads. Yeah, looks really good. Looks really good for whether you wanted to put on a directional trade or a strangle. Could easily do that. There's a nice March strangle. Nice delta for just going long. So here's the dichotomy for this, right? Elliott would say this is likely to break to the upside. The most recent educational series that we did for our subscribers on our website was on triangles. And what I try to do, because I've been doing this for 25 years, that's a long time. You see a lot of things in 25 years. I hate thinking about the fact that I'm that old, but I am. But you notice a lot of things in that amount of time. And what I've noticed is that when you have a corrective triangle, and this isn't necessarily the corrective triangle, right? A triangle is you have a wave 1, 2, 3, 4, and 5. So you have the full wave 5 pattern ends. Then you have a triangle. That's a pure Elliott wave corrective triangle. That could break either way. There is just, that could break either way. you're just guessing if you're picking a direction on those. But Elliott, in his works, would say that when you had a triangle in this pattern, the likelihood is it breaks in the direction of the pattern, especially in a wave 3. And what I added in there is like, well, in the real world of trading, the way I look at triangles is regardless of the scenario, it can break either direction. Now, if you were to trade this specifically bullish and it breaks to the upside, or you were to trade this as a strangle and it breaks to the upside, obviously the direct break to the upside is going to make more, right? Because if you have a strangle on, the call is going to make money, the put's going to lose money. The call is going to make money quickly, the put's going to lose money slower because of the way we do them. But it's inevitable that one's making money and one's losing money. You can't get away from that. You can minimize it as much as mathematically possible, which is what we do, but you can't get away from it altogether. So with less risk comes less reward. You know, it's all risk reward. So if you look at this as a strangle and it breaks to the upside, you're still going to make money. You just wouldn't make as much if it was an upside breakout. We're sitting here on top of the most recent highs in June. So that's kind of the support area. So the triangle has formed with the point right above there. And boy, with that, look at that. It's broken below where it was recently. With that ADX that low, you'd really have to look at that and say that this is probably going to break relatively soon. So I'll leave the decision to you as far as what you choose to do with this, but we're going to pick this as a consolidating pattern. So we're going to pick Nike as a directional trade, and we're going to add this as, I'm going to say as a strangle. So I've given you the fact that Elliott wouldn't be mad at you if you traded it as a bullish trade, then manage your risk if things were to go against you. The less risky trade is the strangle. It sets up really well. There's no reason not to do it from an option standpoint. So that sets up well, but obviously, even though you could generate a nice return out of it, it's not going to be the same as the directional move. You can factor in the fact that it's in the financial sector, and the financial sector is one of the best sectors. I mean, we have 2 directional trades for our subscribers already. Do you want to put a third one in there? I don't know that that makes a lot of sense either. So if it breaks out, it's not really a doji, but not too far off from one right there at the point. I think this could break really soon. Like in the next day or two, this thing could break out and move. So I really like that. That's my thought process on it. Again, you decide how you would like to trade the pattern. I've given you both the pluses and the minuses, the rules, the guidelines, experience, everything else. But I think we've got some really good ones to pick from that we've selected as our case study considerations for this week. Okay, let's go ahead and take a look at some of your questions. And basically, you're already just putting symbols in there. So let's look at symbols. Not really questions, just you want to look at symbols. So we have a few minutes left. Let's see, get as many as we can. So CrowdStrike, woo, I don't like that vertical stuff. You know that. What a nice move. Hopefully you were in it, Ryan. I hope you were in that and took advantage of that move. If so, congratulations. But there's no 5-wave pattern here, but certainly that has to be a zigzag, I would think. You came out of the flats over here. So this is all flat stuff here. Don't worry about labeling that at the moment. Let's just take a look at where we are with this zigzag. 100% extension. So you're where you're supposed to go. So we're at the 61.8% fib corrective level. That's supposed to extend 100%. It did. And notice, here's this Fibonacci stuff. I mean, if you're not a believer in this now, and you've been watching us for months and months, I don't know what it's going to take to make you a believer in it. But look, ran right up to 61.8, came back. What did I say earlier? Tested the previous fib level, and then moved to the next level. It's just as classic as it could get in this move, but that's pretty vertical. You're looking at the 10-day moving average, and I'll spare you, I won't say it again, but you already know what I'm going to say with that. It's hit its target. It's overbought at the time, short term. Really incredible move over the last 4 days. So if you were in it and you stay now, maybe you're getting a touch greedy. Or if it's a long-term thing and you wanted to wait for the long term, then, you know, I could see that, but you might have to withstand a little bit of a pullback here. It may be brief. It may go sideways. Remember, when stocks are overbought, it doesn't necessarily mean they're correcting back down. They can correct sideways, and I say correct in order to let the 10-day moving average catch up, but they can just go sideways and let the 10-day moving average catch up. Overbought conditions are not always resolved by a retracement. Sometimes it's a sideways resolution. But wow, that's a really nice move. ARKK. So we did ARKW. So pretty similar looking chart as you would expect it to be. Walmart. Julian. Boy, that wave 5 is already extended 170%. So that means it's gone past 100% extension, past 161.8% extension. Is it going to go to 261.8? That's where the next move would be. I would have to look at the DMI to see that. So you would think Walmart, this is their time of year, right? It's the holiday season. We know they've really beefed up their online presence, which is part of the reason the stock has had this run since July. That move to the upside there. They've done a really good job of competing with Amazon with their online, getting stuff out, pick stuff up at the store without touching anybody. You go, there's big tubes there, and you just go in and get your stuff. You don't even need to talk to anybody. You walk in, get your package, and leave. But right now, it just looks like the ADX is saying the strongest part of the move is over. The thing that you could look at here, if you are bullish on the stock or if you're in it, is the two directional indicators came together and kissed. I talk about that scenario quite often because you see it a lot, where it looks like, all right, the positive directional indicator is diving down, the negative directional indicators are moving up, the sellers are going to take control, the buyers are done, the sellers that's what it looks like is going to happen. And sometimes those lines just come together and kiss and go back the other way, which is maybe what happened here. You had a nice update today. I just think if you're in it, I'd just be tightening stops or, you know, not letting too much of a corrective move happen before you got out. If you were looking to get in, I think I would wait just a little bit. You're not very far away from these highs. I would want to see, if it was me, I would want to see those highs taken out. And if those highs get taken out, then you're going to have a lot better looking DMI to confirm a continued move higher. But already going to the 161.8, the next level is 261.8. It happens. Doesn't happen all that often, though. I mean, it does. It happens, but it's just not a high percentage thing. The stocks extend all the way to the 261.8% level. Tesla, of course, we can't have any sort of an event without looking at Tesla. Now, you got to be careful on this because Elon announced another round of he's diluting the shares again, which they had their split. We had this beautiful triangle, and I went out on a limb and said that's going to break out. It's too good of a triangle. It's going to, you know, I said that it's going to break out. It did. It broke vertically, just a little tiny bit of a pullback, but now he's diluting the shares again. So he's doing another round of revenue raising, money raising, and so he's going to dilute the shares even further than they just were from the big split that they had. If it can power higher from here, that would be some impressive move. I would be surprised, but this stock has confounded everybody since the day it went public. So I wouldn't put anything past this stock. Elon Musk is a brilliant guy. He's a visionary. He gets a lot of, people are putting a lot of faith in that because the valuation is insane on this stock. You've heard that, I'm sure. But then you look at the DMI and it looks pretty good. So the DMI looks like, yeah, you could go higher from here. But let's see if that announced, going to sell more shares, widen the float a bit, increase the float. That's going to dilute it. It's going to be hard to maintain. Even if it goes higher from here, it's going to be hard to maintain the momentum that it's shown since the breakout of the triangle. It'd be very difficult to do that when you're diluting shares because there's a lot more shares to buy. So I'd be careful of that one at this point in time, just because of that. If it wasn't for that, you could say that, well, the DMI is showing you could go higher from here, but that's not just a fundamental thing. That's an actual physical thing. There's more shares now, so there's more shares. The buying is going to have to increase at the same percentage as the percentage of new shares to maintain that move. And can it do that? I don't know. We'll have to wait and see. I'm just think we should be a little cautious there. Hey, Constantine, how are you? Good to hear from you. Jeremy HD. Woo. Wow. Not a great triangle pattern, but look at that. Testing support with a doji today. You could call it a descending triangle, really. But man, that could be fun. Something's going to happen to that one. See the triangle back here? I hope y'all are starting to see these when you look at charts, because they work. The stocks break from those things. So there's a big run to the upside. Nice triangle here. Wonder where. No. I was wondering if that was the end of a wave 5 and then it went there, but it wasn't. It was a wave 3. And there's the break. So that's the same thing that we were just talking about with Truist, right? So, Truist that was a wave 3 with the triangle, and it did break to the upside, like Elliott said it might. So that one did do what you would expect. But that's it's a decent descending triangle, and what I was going to say is that if this breaks, you have a quick run back up here. So from 260 to 290, 30-point move there. If it breaks to the downside, that's not really a whole lot of resistance there at the point of that triangle. Is it coming all the way back down here to the March lows? I don't know. That would be hard to believe. It'd be difficult to see that scenario occurring, but there is nothing in the way. That was just such a nice move to the upside. There's no real resistance in the way on the way down, unless it would just hold this weak amount of resistance here at this wave 2 high around 250. That's going to be interesting to see over the next couple of days, or the next couple of weeks. Keep reminding me on that. Pankaj, you want to look at Exxon Mobil? They were getting a lot of criticism. There was a activist. I don't know if you saw that, Pankaj, but there was an activist on the financial networks today. He's trying to. He feels like they're just blowing money, that they're wasting money on just frivolous endeavors, and he's trying to get some board control and tighter board control, if you will, to tighten the ship up a little bit, to activist type of stuff to get them to pay a little bit more attention to the bottom line and not some of the things that this person at least feels that are waste of money type of investments that don't have a likelihood of returning a decent return based on the capital that's being put into them. But energy sector is doing well. We talked about that. There's resistance there at 45. The DMI looks good. I mean, it looks like Exxon Mobil is going to go test that 45 level. And, you know, the whole activist world, sometimes it's viewed as a positive, sometimes it's a negative. It's hard to know whether or not that's going to come back and be a good thing or a bad thing for the company, or even if it's going to gain traction, if that is going to matter at all. But decent looking charts. PLTR. A lot of talk about this one on the financial networks today as well. So it had a big move yesterday because they got a $44 million contract from the FDA. And the argument from the naysayer today on the financial networks is that, well, it's a multi-billion-dollar company, and yeah, $44 million contract is nice, but doesn't really move the needle that much on a company that's that big, but it's definitely in a momentum phase. So we had the triangle here. Remember, we talked about Elliott saying that some triangles are small. And yesterday was the big breakout day. No follow-through day today, though, so that bears watching. See if it can continue to gain traction and continue to the upside from here. But yesterday's news was certainly good, and you can see how far away it got from the 10-day moving average on the open today. So it opened much higher and then came back down because it was just too overbought. There wasn't enough energy to try to make a run at that new high. But the people that are negative, and remember, a stock cannot go higher unless somebody sells it. So having naysayers, short sellers, things like that, it's not always a bad thing. Quite often it's a good thing because if the stock continues to move and they're wrong, then they have to cover their short positions, which means they have to buy. It doesn't necessarily mean that the stock can't go higher because people are being critical of the financial. I mean, look where Tesla is again, and you can't justify that one from. You can't justify that one from fundamentals for sure. Microsoft. I think that we looked at this one last week too. Or it's this really nice triangle. Really good basing triangle. So here's your corrective triangle. This is what I was talking about, where you have a wave 5 that ends, then you have your symmetrical triangle. That's the corrective triangle. So this one, even Elliott says, that could go either way. So I'm just going to follow along with the rules and say, there's no way to know. If you follow the Elliott Wave rules, there's no way to know which way this is going to go. It could go up or down. The ADX is getting very low. So I don't think we're going to have to wait much longer. It's actually below 8. So Microsoft is probably going to break here very soon. And, you know, the ADX that's about as low as you see the ADX. And it's a really nice looking pattern. So Microsoft is probably going to move, make a note of it to look in the following weeks. It looks like it's ready to go. Again, no way to know which way. Mark, expensive options. When they talk about options being expensive, there's a mathematical formula that goes into creating the price of an option. The Greeks, delta, gamma, theta, vega, even rho, and some. Says interest rates are so low that rho really nobody even talks about it anymore because it's hardly even a component. But back when interest rates were high, it mattered. Doesn't really matter so much anymore. But there's different components that goes into an options price. When there's juiced volatility, when the implied volatility that's pumped up, like it's a stock that really moves, or it's a stock that they think is going to move, the market makers, they'll pump up the volatility. And that means that in general terms, the options are considered expensive because there's extra volatility being priced in, expecting that there's going to be volatility in the stock. So there's historical volatility, which is the volatility of a stock movement. And then there's implied volatility, which is taken from historical volatility. That goes into the component of options pricing. So quite often when they talk about options being expensive, that's what they're talking about, is the IV is juiced. And so you're paying more than you would if there wasn't, either if the stock hadn't been moving a lot, or if there wasn't some sort of expectation built in that the stock is going to move. Craig, when I say volatile, do I mean the market will pull back? It's a really good question. I think January is going to be far more volatile than where we are right now. See, looking at these intraday moves, that's extremely low volatility. And if we look at the VIX, you can see that we're moving back down, breaking below this level of support there, trying to break above it, and it couldn't, and we're heading back down. And I've noted in the past, which I'll be talking about this in the recording as well, that there's a chance that that gap gets filled between now and the end of the year if we continue in this low volatility environment. So there's two answers to your question. One is this move to the upside is incredibly low intraday volatility. So the daily bars from the low to the high are very small. I think the volatility of the market itself is going to increase in January. I think we're going to go back to having more days like this where you have more intraday volatility, bigger swings from the low to the high of the day. I think that's almost a given that that's going to occur. Now, the second part is, especially when you're talking about the VIX, the volatility index, when the VIX goes up, it normally coincides with the market going down, right? I mean, normally when the markets get more volatile, in general terms, talking about downward moves, at least when you're talking about the VIX. I do think there's a good chance that we're going to have a corrective move in January. I would be surprised if we hit that 420 level, but we might. If we do go to 420, then I think we're really going to have a decent pullback from that point in time. My personal opinion is, yes, I think we have a pullback in January. That's a personal opinion. What the charts are telling us and what the VIX is telling us is that the volatility from an intraday standpoint, day-to-day movements in the market is likely to increase a lot in January. So one's an opinion, one is based on the charts, etc. BAC and IWM. Question, how do I select which strike month to buy? Usually I'll go 30 days out from a forecasted month. So if there's, if the zigzag, the C staying on the 45-degree angle gives you December, I would look at January. If it gave you January, look at February. You always want to go longer than the time frame expected to try to avoid that massive amount of time decay that occurs in the last 30 days. So BAC and IWM, then we'll wrap things up. So Bank of America, obviously a financial. Here's one of your triangles. Another one that did back-to-back. So this is not unlike our Truist chart where we had an expanding triangle and then a consolidating triangle. Well, this one had a symmetrical triangle and went right into an ascending triangle. Both of them back-to-back triangles. Pretty interesting stuff. It's going to do something. But it's a very small move. The entire triangle is only 1 point from the low to the high in the mouth of the triangle. So it doesn't necessarily mean it's going to be a big move. and the target is only 31. But, you know, Bank of America is so widely owned, that's a decent move in that stock. It's had a decent move so far. So it's a difficult one to trade the strangle because it's not a very big move, but it's not 10%. It would need to be forecasting a 2 to 3 point move before we would consider doing a strangle. So my consideration here would be let it break and then trade the direction of the breakout. All right, let's look at those small caps, and then we'll end things for the night. So the Russell continuing to power longs, driving the market, and we had a bullish trade on this for our subscribers. We've already taken it off. We took our gain back here, and it's continued to move a little bit higher from there, but now we're at 100% wave 5 extension. So that bears watching to see if that creates any sort of resistance. You look at the DMI now, is there momentum for it to continue up to go to the next level, 161.8, and the ADX is telling you the strongest part of the move is over. Super strong ADX though, look great. Good looking DMI. Buyers are still in control. You see the positive directional indicators going up, negative ones going down. The buyers are still controlling things here. And just to reiterate one more time, and I'll repeat myself a lot, but a lot of these things, I want you to hear them and get them in your mind, is that just because the strongest part of the move is over doesn't mean it can't go higher. But once you get that signal that the strongest part of the move is over, that's when you just a little tighter on stops if you're trading stock, maybe a little more less loose with your risk management if you're trading options, etc. It just means that you kind of watch things a little closer for more of a pullback. But man, that would be impressive if it goes to 161.8. We need to have maybe the ADX calm down a little bit, let that positive directional indicator get back above it. But 3 good days in a row for the small caps, and they are the leadership right now. They really are. Thanks for your attention. As always, have a great week. We'll see you next week.